Domino's Pizza has been an interesting company for me in the last 5 years because of how inflation has created an increase in the price of food away from home. Domino's Pizza is one of the lowest priced options for a family when they don't want to cook at home and they want to eat out or order food for delivery. Interestingly, I'm going to do a discounted cash flow valuation on Domino's stock and answer what's a fair price to pay for this business? What's a good price per share for in this business? So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so here I have a discounted cash flow valuation model for Domino's Pizza. And as you notice, there's a lot of numbers to digest here, and I'm going to go with you step by step explaining what these numbers are, and then finally arriving at my intrinsic value per share and explaining what that value means. So let's start with the free cash flow forecasts starting in 2024. Domino's Pizza, when 2024 is completed, when its financial reports are completed, it's expected to have 550 million in free cash flow. That's expected to increase for the next few years, culminating in a forecast of 700 million in free cash flow in 2028. So these are forecasts from Wall Street analysts that are following Domino's stock. From 2029 to 2034, I forecasted its free cash flow to grow at 6.4% in those next 5 years. And then from 2035 on to infinity, I forecast the company's free cash flow to grow at a 5% rate because that's the rate of increase I expect in free cash flow in the growth of nominal GDP in the countries where Domino's Pizza operates. Now, underneath those numbers, I have the present value of those calculations. If you're not a finance major, you probably haven't heard of present value or the time value of money. But what this concept does is it accounts for the fact that this cash flow is expected in the future, and everyone would rather have money today. So if you got to take money in the future instead of today, that money in the future is worth less to you. And this calculation attempts to place a value on the time for receiving the money. That's why the concept is called the time value of money. And when we take the present value of all of those cash flows, it amounts to 4.9 billion between 2024 and 2034. The value of the cash flows between 2035 and infinity, we can use a shortcut terminal value calculation instead of individually forecasting all of those cash flows. And this terminal value for Domino's came to $27 billion. And when I took the present value of that, it came to $11.5 billion. So in sum, the value of operations, including the present value of terminal value and the present value of the cash flows from the next decade, totaled $16.4 billion for Domino's stock. Now, the discount rate that I utilized for Domino's was 8.94%, and I arrived at that by assigning the company a 7% cost of debt and a 9.9% cost of equity. And since the company has $5.2 billion in debt and $15 billion in market cap, I gave them a target capital structure of 33% debt and 66% equity. The numbers highlighted in blue here are numbers that I got from Yahoo Finance under the Domino's Pizza section, and the numbers for the free cash flow estimates between 2024 and 2028 I got from ticker.com, and they use Wall Street analyst estimates to deliver those free cash flow numbers between 2024 and 2028. So that's how I arrived at the weighted average cost of capital of 8.94% for Domino's Pizza. So now we can draw our attention to the value of operations, which came to 16.4 billion. We need to add to that the cash balance of the company of 189 million and subtract the total debt of 5.2 billion dollars. That brings us to a value of equity of 11.4 billion. And if we divide the number of shares outstanding, we get an intrinsic value per share of $325. That compares to the current market price of $435 for Domino's Pizza stock. So even if I apply a margin of safety, which for a stock like Domino's, I wouldn't apply a very large margin of safety. The company has a beta of 0.86, so it's a less than average risk business. So a margin of safety between 5 and 8% would be appropriate for Domino's Pizza. And so even applying a margin of safety, if I look at the intrinsic value per share of 325 compared to the current market price of 435, it would indicate that Domino's Pizza stock is overvalued. Now, Domino's Pizza is an excellent business, and the stock may remain overvalued forever. It may never come down to this intrinsic value per share calculation I made here. Furthermore, I used several estimates and assumptions to make this calculation. Maybe I used a number that was too high or a number that was too low, and that caused this calculation to look much different than what many other stock market investors might perceive. So that's the interesting thing with these intrinsic value calculations and the stock market in general. Every transaction, every day, stocks are changing hands. One person is selling because they might think that stock is overvalued. Another person is buying because they think that stock is undervalued. You have the same stock, two different opinions. And you get that with nearly every business in the market where you have two sides of opinions. One is bullish, one is bearish, one is selling, one is buying. And it's a matter of the inputs that you use in these calculations and then qualitative factors that I haven't considered very much in this calculation. What's going to be the long-term impact to Domino's Pizza with the rise of these food delivery companies like DoorDash and Uber? Domino's formerly competed with fewer businesses for food delivery, and now nearly every restaurant is a food delivery competitor to Domino's. What's going to be the impact to that, right? Is that already incorporated in these free cash flow estimates? Is it incorporated too optimistically, or should there be a bigger decrease because of those risks, right? Those are some of the factors that could change these calculations dramatically from one person to the next and change these estimates dramatically from one person to the next. So I encourage you to do your own due diligence. Do not rely on my calculations to make your investment decisions. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.